Welcome back, traders and investors. We had David Tawil on the line here. Now, David is co-founder of Maglan Capital and serves as a portfolio manager prior to finding that firm. So, David, how you doing today?
I'm great. How you doing?
Good, good. So, you got some expertise here in post reorganization equities. How did you end up following that sector?
Well, it's really part of our background. Just to give you a little bit of history. So my partner and I started our careers out as bankruptcy attorneys. When we started investing after our stint at Credit Suisse for a number of years, we started at a pretty deep part of the distress cycle in 2009 and 2010 when there was a lot of distressed debt out there. But every time we invest in distressed debt, it's really on a loan-to-own basis. We look at the debt as the fulcrum security and essentially the equity for a reorganized company. And what we noticed is after the recovery gained some momentum into 2011 and 2012, there were a lot of equities that were out there, even ones that were publicly listed, that weren't being shown any love by the long-only community. They were left by the distressed debt investment community. And so therefore that void we went ahead and took advantage of now for close to 3 years.
Okay, so when you do go into these companies, are you actually looking at making investments in the company and becoming, let's say, vis-a-vis an owner, or are you actually just going out here? I'm looking at some of the stocks here. Are you going out and purchasing the shares in the open market and trying to take like an activist role?
Some and some. We primarily remain passive. We're happy to be active if necessary. We have pretty strong banking and legal backgrounds, so that's not an area that we're shy from. But nonetheless, primarily looking for very deep value plays, but remaining pretty passive and concentrating on existing management to do the right thing.
Okay, so let's talk about some of your multi-year holds right now and kind of what got you into them, and also like your exit strategy here. I'm looking at Fairpoint Communications here. The stock has had a nice run up. What attracted you to it, and what's your longer term plan with it?
Absolutely. So we've been investing in Fairpoint even prior from it emerging from bankruptcy. We actually owned the debt when the company was in Chapter 11. It became much more exciting to us after stock collapsed upon its emergence from bankruptcy. Stock traded down from about mid-20s to as low as below $4 a share. We were enormous investors down in the single digits and have been concentrated on the investment since then. What we see in terms of excitement is, in contrast to other traditional telecommunications companies, this is the sixth largest telecom provider in the United States, basic, voice and data service up in northern New England primarily. They have a top line that has hit an inflection point and is going to go ahead and grow, which is remarkable for a telecom company. At the same time, they have a cost structure that's coming down, and so therefore their EBITDA and their cash flow is growing, and it's still valued at a pretty substantial discount to comparable companies like Frontier, CenturyLink, and Windstream. And on top of all that, these guys don't yet pay an equity dividend, which they could sometime in the future.
So you're still holding. You got in on the downturn, and you're holding your position here. Do you have like a specific target that you're looking for, or do you just take these equities as they start to go your way, and then take profits along the way?
Well, we look primarily, we're an event-driven fund, so we look towards particular events to go ahead and unlock value. So we're waiting for certain things to occur. The company has a pretty substantial unionized labor force, and that collective bargaining agreement that governs that labor force is up for renewal this coming August. So that's an event that we're looking for. Post that agreement being reached, and that could take some time for them to work that out. But they should go ahead and optimize their capital structure, and then thereafter they may go ahead and be inclined to pay an equity dividend, and then eventually maybe be merged into one of the larger players in the space. In terms of price target, I mean, we have some ideas around where we think fair value is based on where comparable companies are trading and where we think EBITDA can get to. We're definitely holders of this stock, well into the mid to high 20s.
Okay, regulatory and legally based investments are something that you also take a look at. And boy, you got to go right to Fannie Mae on this one. Are you participating in this issue?
Yeah, we're in the common equity of Fannie Mae and Freddie Mac. Excited about it. We got into it about 2 months ago. And to us, it obviously falls back onto our, deep legal background and our thoughts around how this process will run in the courts now that a lot of the political risk has abated for a while, at least until we start another session in Congress. A lot of the action is going to be centered in on the courts and the discovery and pretrial motions that are going to occur throughout the summer.
Okay, so you're looking for, I mean, just based on your education and background, you think there's a pretty good case that for Fannie Mae and Freddie Mac to survive in the courtroom, huh?
We think so. Yeah, we think that the shareholders have a much better legal argument. The way that obviously it's binary when anything goes to court. The judge could rule against them, but we think that they have the better of the legal arguments. In terms of the political overlay and the overhang, we waited till a lot of that had passed for this session. And so therefore, Congress can't go ahead and obliterate the two entities. We think that they are important parts of the housing finance market, critical to the overall recovery. And so therefore, we'll watch things wind their way through this summer. Another another legal and regulatory play that we've been involved in and that has done extremely well of late is Global Star. GSAT is the ticker, up over 30% last month. And there it's about an FCC regulatory play where the company's spectrum could go ahead and be converted for Wi-Fi usage. And that's picking up momentum as that winds through the formal process with the Federal Communications Commission.
Yeah, I have seen that stock has had a nice run. Another thing that I'm following, and I'm not sure if you're participating in, I believe, is it Arrow? Is that the company that's trying to basically steal the signals from the major media companies and reproduce it? Are you following that saga at all?
Not part of our portfolio. It really wouldn't fit our strategy because everything that we do is focused on turnaround, restructuring, reorganization. As a matter of fact, Global Star is a company of the satellite business generally, like Iridium, Loral Space, and so on, that all went bankrupt in the early 2000s. We had worked on some of these bankruptcies in that period of time, and so therefore we knew about the assets that Global Star owns.
Okay. Also, just getting into, if you're following things on the legal side, the ongoing in the marijuana sector. Is there anything that you're following there, and any possible plays? I mean, some of these are pretty low price stocks. You following the legal saga with the SEC and whatnot with that sector?
Nothing for us there. Although it's an exciting space, it's not something that we've concentrated on.
Okay, so looking forward here, we've seen a couple things that the Global Star and the Fannie Mae and Fairpoint Communications. Anything that's on your radar now? Perhaps some undervalued small cap equities.
Certainly, we've been involved with H.H. Gregg, which is a pretty consumer-friendly company. They are a regional appliance and consumer electronics retailer. We like the fundamentals there. It's a company that's misunderstood in the sense that people think they're just an electronics shop. And in fact, the primary focus of the business and the turnaround has been over the past 3 years to focus more and more on appliances, which are much less prone to e-tailing, showrooming, higher margins, lots of add-on products like warranties and installation and repair and so forth. But the crazy thing about this one is, in addition to the good fundamentals that they've got, the technicals are mind-blowing. There's a float of 10.8 million shares. The short interest at last count is about 7 million shares. And it's the company which recently released their quarterly earnings. They went ahead and authorized a $40 million buyback program, which translates roughly into 4.5 million shares. Yes, if you do the math, that yields greater than 100% short interest if they go ahead and buy those shares authorized under the buyback. So we could be involved with a pretty crazy technical short squeeze on this one. And on top of that, like I said, we like the fundamentals of this situation, very much lumped together with Radio Shack and Best Buy, but yet, very different than those businesses when you drill down on it.
Yeah, there's been some rumblings with Best Buy, or excuse me, with Radio Shack as of late. Anything that piques your interest there?
We've looked at it. We just don't believe in the long-term prospects for the business. We haven't been involved in the debt. Obviously, it's pretty closely held, debt issue, and a couple of notable players involved there. Previously in our history, we were involved in Circuit City, so we kind of know how these electronics retailers, can easily shut their lights pretty quickly. So, any bid coming out of the UAE that there's rumored to be, we know that those can come and go pretty quickly. There was one that came out of Mexico in the case of Circuit City that ended up being a pipe dream. So we're not too interested in Radio Shack right now.
Okay, just overall market thoughts here. I mean, I see the plays that you're involved in here seem to, be very specific. And even if you have a downturn in the market, you're looking at fundamental value and book value and whatnot. Any thoughts here on the overall market?
We think it's good and strong, at least from a corporate perspective. In this country, we've got lots of bond buying going on by the Fed. We have low interest rates pegged there for a long period of time. And so therefore, equities should continue to be strong and exciting in terms of being able to identify opportunities on a deep value side. Lots of the big cap names have been, full up run over the past 2 years, but we're finding a lot of exciting opportunities in the middle and lower market cap band.
Okay, all right. We've had David Tawil here, and he's the co-founder of Maglan Capital, serves as the portfolio manager. David, thanks a lot for coming on. It's good to take a look at equities that are kind of under the radar here, and the fundamentals and things that you're looking at. And we'll keep an eye on the equities that you talked about, and certainly like to have you back on the show again.
It'd be my pleasure. Have a great day.